Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hi, everyone. Thank you so much for coming today. Welcome to our presentation on Puerto Rico's Act 60 tax incentives, the essential guide for accountants. Today, we're going to be covering an overview of Act 60, eligibility, compliance, IRS scrutiny, how CPAs can help. Throughout this presentation, please feel free to ask some questions in the chat, and I'll try and answer them all at the end. So let's dive in. A little bit about me first. My name is Rachel Farris, and I'm a CPA. I'm the founder of my own firm, which specializes in tax advisory and compliance for individuals and businesses relocating to Puerto Rico under Act 60. I'm also the founder of TaxStack AI, which provides AI-powered solutions to small-sized accounting firms. So you might be wondering, why are we talking about Puerto Rico? Well, the Act 60 has been in the news a lot lately, with the DOJ and IRS cracking down. I don't know if you read the New York Times or the Wall Street Journal, but earlier this year, there was a publicized criminal case of an Act 60 decree holder misusing the tax incentives. And we're seeing more and more crackdown as the year has really gone on. Despite the recent scrutiny, though, Act 60 is a really great opportunity for your clients. It must be done the correct way, though. Many people are ill-informed and try to skirt around the rules. I always like the saying, you can't have your cake and eat it too, and I think that perfectly describes Act 60. It's a fantastic tool if used appropriately, and to do that, people need the help of CPAs like yourselves. Right now, we're seeing a huge influx of high net worth individuals, crypto investors, day traders, service businesses, and more moving down to Puerto Rico. And it's our job as CPAs to fill in that gap and advise our clients properly. So while you might not be specialized in Puerto Rico or Act 60 yourself, you may have clients coming to you asking questions. And it's important to know a base level of what Act 60 is really about, how territory tax rules work, and then also who to reach out to if you need some additional assistance. So let's get into some of the history of Act 60. The Act originally began in 2012 with Acts 20 and 22, in an effort to bring money, entrepreneurship, and talent to the island. After Hurricane Maria in 2017, the territory was left fairly devastated in certain areas, and they revamped the Act in 2019 by consolidating Acts 20 and 22 into a single law. The purpose of Act 60 is to stimulate economic development and attract investment and entrepreneurship to the island. There are a lot of different tax incentives under Act 60, which we'll briefly touch on later in the presentation. But the two key incentives that we're going to do a deep dive in today are the Export Services Incentive and the Individual Investor Incentive. These are the most popular incentives that most people think about when they think about Act 60 or moving down to Puerto Rico. While there are benefits that could serve a multitude of your other clients, these are the two that will most likely apply. So a question I often get is, how is this possible? A lot of people automatically think it sounds like a tax haven or people are just scamming the government to get out of taxes. But if you've actually ever heard the phrase, no taxation without representation, this is the perfect case example. Puerto Rico has no voting representation in the federal government, so they're actually able to make their own laws and tax laws from that. This is a lot different than other popular tax havens like Dubai, Singapore, or the Cayman Islands, that Puerto Rico is a U.S. territory. US citizens, as we all know, are taxed on their worldwide income, so individuals are actually able to keep their US citizenship and their US passport while they're living in Puerto Rico and still take advantage of these tax incentives. There is no other program like this on the entire planet. It is one of the only places you can legally evade taxes, quote unquote, and keep your citizenship. Now, I get the question a lot, why not other territories? Well, in reality, other territories could open this up, but they just don't have the infrastructure and the current program like Puerto Rico does right now. Potentially, your clients could move to Guam and still avoid certain federal US taxes, but the reality is that Guam doesn't have the same infrastructure that Puerto Rico does, and they don't have the same type of built-up program. So right now, Puerto Rico is one of the only options. Let's dive into some of the tax benefits. There are a lot of tax benefits that Act 60 offers, but these are the main highlights that I commonly see people moving down for. It's a 0% tax on short and long-term capital gains earned after establishing residency. That's a very key detail. It doesn't apply if your client has owned Apple stock for 10 years and they decide to move to Puerto Rico and sell it 3 months later. All those capital gains will not be attributed to Puerto Rico. It's everything earned after establishing residency. It's also a 0% tax on Puerto Rico sourced dividends and interest. Generally, that means coming from an actual Puerto Rican company. A 4% corporate tax rate on eligible export services. 100% tax rate on a tax exemption on dividends paid to Puerto Rico resident owners. And potential property and municipal tax exemptions, depending on the size of the business and industry. Next up, we're going to touch on what eligibility looks like for individuals. To establish bona fide residency, you must meet 3 tests. You've likely heard of these, but we're going to dive a little bit more in depth here. The first test is the presence test, or what I like to say is the where are you physically located test. I generally advise clients that you should not spend too many days in the US and you should spend as many days as possible in Puerto Rico to not just skim that 183-day or other safe harbor guidelines. You want to show legitimate intent to move and establish residency, and in your first few years, that involves staying on the island the majority of your time. There are certain exemptions that can count as Puerto Rico days, and it's also important to recognize state-by-state rules for what's considered a day in that state. If you think about New York, for example, there are certain rules where even transiting through New York City or spending 5 minutes in New York City could potentially count as a full day in New York City. So as CPAs, it's very important to evaluate what our clients' residency and travel is looking like to make sure that they're fully meeting these requirements and they're not just skimming that threshold. Please note that days for residency purposes are not the same as days for income sourcing purposes under the Export Services Decree. This means that just because someone lives in Puerto Rico 183 days of the year doesn't mean that all their business income for that year will be sourced to Puerto Rico. If you work outside of Puerto Rico, that income will not be considered Puerto Rico sourced income and included under the tax exemption. For individual investors, we recommend initiating trades when you are physically located in Puerto Rico. So if you're buying, selling, anything like that, initiate it while you as a person are physically located down there. Don't initiate it while you're traveling in New York or you're traveling somewhere else. You want to make sure that without a doubt that is sourced back to Puerto Rico. Next is the tax home test. This one's fairly simple, but it's where your business or employment's located. You can't be employed in New York City and decide you're going to work remotely in Puerto Rico to claim the benefits without jumping through the proper hoops. You genuinely need to have a business or employment located down there legally. You cannot just be a digital nomad that decided to work down there without, again, going through the proper loops to make sure that you're actually being qualified under that test. And then finally, the closer connection test. This is the most subjective test, and I think this is also one of the hardest tests to really meet, and it's where I see a lot of scrutiny coming into play. I like to think of it as where your heart is actually located. Like I said before, you can't have your cake and eat it too. This is really where I see the most pitfalls, and I believe this is where we're going to have the most issues with residency audits coming forward. There isn't really a strict set of rules, and that's what makes this so difficult. Everyone's propensity for risk looks different, but in general, what I recommend for clients is leaving your whole life behind in the US. Don't keep a house available for use. You should sell it or rent it out at arm's length for long durations of time. Yes, that means you cannot Airbnb that house. You want to make sure you do not have the ability to go back there and stay. Don't keep a car there, ship your car down, or sell it and buy a new car in Puerto Rico. Be careful about storage units back in the United States. Your whole family should also move with you. Your wife, husband, kids, and under the age of 18, anyone that's dependent on you should be moving. I often see cases where parents want their kids to go live with the grandparents and stay in school there, or the wife stays behind and the husband moves out, or the kids are in boarding school. That just opens you up to a lot of unnecessary risk. And it also means your clients are likely going to have to travel back to the US more than maybe we would likely want them to. And so it's important that they're really relocating their life down there. A quick rule of thumb to think about is your client should have to take a suitcase with them every single time they have to return to the US because they don't have anything with the trappings of a regular life there. So they don't have a house that has a TV there. They don't keep a toothbrush there. They don't keep a car there. Every single time they go, they need to bring their own suitcase full of clothes, toiletries, etc. because they don't actually have a life in the United States. Also, it's really important to actually get involved in the Puerto Rico community and establish relationships that you had in the US. I think a really big issue with this is people move down and they stay in their little circles and they're really just using this for the tax benefits. And while there are pros to that, it's also important that you actually get involved, not just for the closer connection test, but to actually, have a better quality of life. The example I'd like to give is that if you went to church in the United States, join a church in Puerto Rico. If you volunteered with the homeless in the United States, try volunteering in Puerto Rico. There's a lot of ways to get involved in the community and really build an upstanding social life down there. Another question I get is medical things. People worry about medical procedures happening in territories. And for medical purposes in general, they mostly understand that large procedures can be done in the United States, but your primary care doctor, dentist, hairstylist, nail manicurist, anyone that you see that isn't emergency on a regular basis should actually be based in Puerto Rico. I think a great way to think about this is you never go see the dentist while you're on vacation. So if you're claiming that you're going on a vacation in the United States and you're not actually living there, well, you shouldn't be seeing the dentist while you're there because that's not something people normally do on vacation. Also, you must renounce your right to vote in US elections. You can register to vote in Puerto Rico, but you cannot vote in federal or state elections anymore. There's a lot more to this, so please just take this as a general guideline. This isn't a one-size-fits model for anyone, and it's important to evaluate your client's individual situation and their propensity for risk to really understand how they will match all three of these tests. Eligibility for businesses looks a bit different. For exporting services, you must engage in eligible services rendered from Puerto Rico to clients or customers outside of Puerto Rico. Again, it's called export services. For example, you can't be a plumber that provides services to people in Puerto Rico and qualify for the incentive. A great way to actually make that compliant is, let's say you run a bunch of plumbing companies back in the United States and you manage all of them. All that management income that your client is bringing in or revenue, that could be sourced to Puerto Rico. But the actual work of the plumber is not going to be sourced back to Puerto Rico. Another thing to mention is that qualifying sectors are quite broad. So we're not going to cover all of them here, but some examples just to get the wheels turning are professional consulting services, financial advisory services, marketing, e-commerce, technology, software development, R&D, investment management. We're seeing a really big influx of hedge funds, private equity, and family offices actually moving down to Puerto Rico as well. Clients should also establish a Puerto Rican entity and employ at least one Puerto Rican resident. This generally varies on the size of the business, and usually that Puerto Rican resident can actually be yourself. But if you're making over a $3 million or your client's making over a $3 million mark, oftentimes you need to involve the community a bit more. And that doesn't mean hiring someone to clean your house. It means hiring someone that's actually involved in the day-to-day business operations. The importance behind this is, let's say your client decides, hey, they're going to live in Puerto Rico for 7 years, take advantage of these benefits and leave. Well, a huge idea behind this is they want to bring more talent and learning into Puerto Rico. So you want to be training the local population in something specific. So if you run an e-commerce business, hopefully by the time your client leaves that island, they will have actually brought on employees that now understand the e-commerce business themselves and can branch out and kind of start their own thing or get a job somewhere else. Another important thing is that clients must maintain an office or physical presence in Puerto Rico. Finally, clients must obtain a tax incentive decree. Now, I know this sounds very obvious to most of us, but so many people come to me and assume that they can just move to Puerto Rico and establish residency and they will automatically receive the benefits. That is not the case. You actually need to file the actual tax decree and get that signed by the government and approved by the government. Just because client moves down and establishes residency does not mean they automatically qualify for the tax exemptions. Now we're going to look at compliance a bit. So compliance for Act 60 can be a little bit tricky. So for the purposes of this presentation, we're just going to cover the main highlights. Again, do not take this at its total word. You need to evaluate individual client situations, but this provides a general guide for what compliance looks like. So as we discussed before, the clients must meet the presence test. So a way to do this is we recommend that clients keep track of their physical presence by keeping logs, travel records, and credit card records. A really important case that I saw recently was that someone in my inner circle was dealing with a client that claimed they were in Puerto Rico and now they are getting audited for residency. And unfortunately, they didn't keep track of where they are. So now they're having to spend all this money in legal fees to basically establish where they were at a point in time. It's much easier to preemptively do this. There are apps like TaxBird that allow clients to track where they are on a daily basis on their phone. You can have them send them your credit card records or any type of travel records, just so in the case that there is an audit, you are able to quickly pull together that information and prove their residency right off the bat. Clients must also maintain a primary home in Puerto Rico. While they can initially rent, they must buy a home in Puerto Rico that serves as a primary residence within 2 years. And so what that looks like is when you first move down, I wouldn't recommend that they get an Airbnb. They should actually sign a lease. The first time they visit Puerto Rico, Airbnb or a hotel is completely fine. But to really start establishing residency, you need to have a legitimate area that serves as their actual home. They must also avoid a closer connection to the mainland US. While this can be quite subjective, this generally means looking at where a person's family is located, where they're voting, where they do banking, where they have social connections, and everything else that I talked about on the previous slide. They also must file an annual report to the Department of Economic Development and Commerce and file tax returns. If your client owns a business, they may also need to file financial statements depending on their income for that year. Clients must also pay necessary annual fees. This is different than the actual tax paid. This is an annual fee that allows them to keep the decree. So a lot of people, again, they think that annual fee is just you paying taxes for Act 60. It is different than that. It is just a fee to the government to keep your decree up and going. And then finally, individuals, investor, decree holders must donate $10,000 to a Puerto Rican charity, with $5,000 of that being donated to a charity that focuses on eradicating child poverty. So if a husband and wife both hold decrees, they both must each donate $10,000 to a Puerto Rican charity every single year. It is not just a one-time donation per family. Now, let's look at IRS and state scrutiny and risks. Commonly, I see issues with residency manipulation on both the state and federal level, where someone claims they were a resident of Puerto Rico for a certain year, but they were actually still considered a resident of the US or a specific state for tax purposes because they did not comply with the presence, tax home, or closer connection tests. Residency audits are some of the most popular forms of audits we see because residency rules change by state, especially if we're looking at states like New York, New Jersey, California, very high auditing states. Oftentimes, I see cases where people believe that they have established residency in Puerto Rico through the presence and tax home tests, but they didn't actually meet the closer connection test. So it's important to be evaluating this on an ongoing basis. This isn't a beginning of the year touch point and an end of the year touch point. This is a continuous process throughout the year because while you might establish a plan with your client on day one of the year, by the last day of the year, you might actually not have followed that plan. So it's important to check in. If you wait all the way until the end, there's no way to remedy that if they haven't been meeting one of these tests. So it's very important to constantly check in with clients. I like to do so on a monthly basis for people that have just moved to Puerto Rico in their first year. After that, I'm down to check every couple months. It really just depends on the client's needs and how much they actually follow the rules that you set for them. Retroactively applying incentives. Incentives only apply after a person has received a decree and becomes a bona fide resident of Puerto Rico. There have been many criminal cases where a person incorrectly dated their residency to get a retroactive application of the tax exemptions. We'll actually talk about one of those cases in detail right after this. Improper sourcing of income. Many people think that just establishing bona fide residency is enough to source their income back to Puerto Rico. This is completely incorrect. If someone runs a business, days for residency purposes, like I mentioned before, are not the same as days for income sourcing purposes. The days a person works in Puerto Rico apply to the exemption, but if a person spends a few months in the US, that income will be US sourced. The same goes for investments. Interest and dividends only receive the tax exemption if they are from a Puerto Rican company. Capital gains do not need to be from a Puerto Rican company, but the trade should be commenced in Puerto Rico. For example, I've seen many cases where an individual hires a hedge fund manager based in the US to invest for them. But since the hedge fund is actually located and the hedge fund manager is located in the US, the income is actually not Puerto Rican sourced because the hedge fund manager is the one making decisions. If any of your clients need assistance with sourcing investments to Puerto Rico, there are professionals at UBS, JP Morgan, and other firms that focus specifically on Act 60 friendly investments. If you have clients that are interested in this, please feel free to reach out to me and I'd be happy to make an introduction. Finally, failure to file Puerto Rican tax returns or US tax returns. I know this sounds funny again, but many people think that with the tax exemption in Puerto Rico, they don't need to file Puerto Rican tax returns or US tax returns. As CPAs, it's crucial that we actually guide our clients through their reporting obligations to make sure they are actually covering all their bases. This is particularly important in the year of the move to or from Puerto Rico because there are special forms that US-based CPAs actually need to file. If they have any US-sourced income during their residency in Puerto Rico, they still must file a US return. That can look like anything from rental property income, small business income when you divvy it out, anything like that, they still must file a US return. Next up, we're going to touch on sham entities. Another area of scrutiny is people who abuse the tax exemption by setting up fake entities. While their business is really operated out of the US, they register it down in Puerto Rico and try and take advantage of these tax incentives. I've even seen cases where people try to VPN in because they think that's enough. The purpose of these tax incentives is to bring capital and entrepreneurship to Puerto Rico. You must have real, legitimate operations on the island to qualify for these incentives. This is not something that you can just skirt around and pretend that you're matching those rules. Your clients genuinely need to be establishing a life and a business down in Puerto Rico. So now let's look at a few brief examples. This is the case I mentioned earlier, the big criminal case. Suresh Gojwani was an investor who held highly appreciated stocks and options. He claimed benefits under Act 60 by falsely backdating his company's conversion to an S corporation, and also claimed that built-in gains accrued before he became a resident would be exempt. The IRS challenged his failure to meet the presence test and other eligibility requirements, and the legitimacy of the legal advice he relied on. He had to pay millions in restitution and is facing criminal penalties with the DOJ right now. Also, there's been multiple IRS campaigns. The IRS has identified a large number of participants suspected of claiming benefits without meeting all the requirements. There are DOJ and IRS agents specifically tasked at focusing on this, and they have a whole operation down in Puerto Rico. So this might sound really scary. Oh, wow, that's a lot of risk for clients to take. But in reality, in my experience, people just aren't doing this the right way. They received bad advice from CPAs or lawyers who didn't know what they were talking about, or just decided to take unnecessary risk because they thought the rules didn't apply to them. The purpose of this is you need to follow the rules to the book. There's no skirting around this to try and make it work for your clients. In reality, they actually need to be willing to move and establish a life. They can't have their cake. They need it too. Another case is Baker McKenzie. Recently, the law firm Baker McKenzie was subpoenaed to provide records relating to its work on Puerto Rico tax planning structures. The firm took enormous risks with opinions it gives to its clients, and most of their clients are likely at risk of being audited. It's so crucial that clients and CPAs approach this correctly to minimize scrutiny and risks. While this course will be helpful for you to get a general understanding, please know that you'll likely need to loop in lawyers or CPAs or specialists in Act 60 to really understand the full implications of the rules. So, what can US CPAs do to help your clients navigate this process? You can help them by verifying residency and presence compliance. You can help them by structuring businesses correctly under Puerto Rican law. You can coordinate with Puerto Rico tax professionals, attorneys, and advisors. You can educate clients on maintaining documentation and the importance of compliance. And you can stay alert to IRS guidance and enforcement updates. No one's expecting you to become a master in Puerto Rican law. It's just knowing enough to be dangerous and knowing when to loop in people and what people to actually loop in. So, we're going to walk through a hypothetical case example to illustrate what correct versus incorrect compliance looks like. To set the scene, a US investor owns a digital marketing business and relocates from California to Puerto Rico in June 2025 with a $5 million stock portfolio. The correct compliance. The client spends 183 or more days in Puerto Rico in 2025, maintains calendar and travel logs. She rents a primary home in San Juan and rents out her previous California home for 1 year at a market rate to someone at arm's length. And she opens up a Puerto Rican entity for her business. She documented what the value of her stock portfolio was on the day she established residency to ensure that she only includes post-move appreciation as Puerto Rico-sourced capital gains. Since she has already operated her business in the US for many years, she has a transfer pricing study done to determine what is sourced to her US entity and what is sourced to her Puerto Rican entity so that she can properly navigate anti-inversion rules. If you're unfamiliar with anti-inversion rules, it's basically the government doesn't want a person uprooting their business, moving it somewhere else to a foreign jurisdiction, and then just doing that for tax purposes. When it's the exact same business, you need to set up proper procedures through a transfer pricing study to make sure that things are going down to Puerto Rico properly and that your client isn't just evading taxes. The client also registers to vote in Puerto Rico. She opens local bank accounts, joins local clubs, and begins a real life in Puerto Rico. She properly divides up what is US sourced income and Puerto Rico sourced income based on the time she spent outside of Puerto Rico and the structure of her income before she established residency in Puerto Rico. Now, let's look at incorrect compliance. She spends only 120 days in Puerto Rico and spends many months back in California claiming she was traveling. She keeps her California home available for use and goes back to it when she visits California. She maintains US voter registration and has frequent social ties to the United States. Her husband moved with her, but her kids are actually staying with their grandparents to continue school in California. She claims that all her business income for the year is sourced to Puerto Rico and that her entire stock portfolio's capital gains before June 2025 are sourced to Puerto Rico. So as you can see, there's a very clear difference between what correct and incorrect compliance looks like. It's important as CPAs that, again, we really look into depth about individual situations. This is not a one-size-fits-all model that you can apply to every single client. You need to really dive in depth to determine what connections they have to the US, what connections do they have to keep in the US, and how can they bolster their Puerto Rican residency to avoid an audit, or if they do get audited, to be able to sleep at night when they actually did things correctly. So, best practices for clients. We recommend that they keep meticulous travel logs, and that includes not just documenting on a piece of paper or a spreadsheet, actually include tickets, the names of the flights, the dates of the flights, file timely Puerto Rican US returns and annual reports, document economic activity in and outside of Puerto Rico. So, if your client decides to go on vacation to New York with their family or to go back and visit family, document what actual activities they did business-wise. Did they take a business call? Did they answer emails? Did they sign any contracts? What revenue is actually being attributed to their time outside of Puerto Rico? Establish genuine ties, home, bank, voter registration, or more. Genuinely establish a life down there. Avoid aggressive positions unsupported by the law. And also be aware of anti-inversion rules. Here are some of the other incentives that we will cover very briefly. There's The difficult to hire employees, researchers and scientists have their own incentive. International financial entities, international companies, private equity funds. There's actually two types. There's Puerto Rico private equity funds, and then there's just private equity funds. Both of them have different levels of incentives, but they're trying to attract businesses like that down to Puerto Rico. There's visitors economy as well. So tourism, manufacturing is a really big one. Puerto Rico already has a lot of manufacturing facilities on the island, specifically in pharmaceuticals, but there are bringing in more incentives to really try and bring manufacturing to the island. And if you have any clients that are interested, this is actually a great way to kind of work around some of the tariffs. We're seeing a really big influx of people interested in this manufacturing side because, again, Puerto Rico makes their own rules. There's green energy incentives. They just unlocked a few more to bring recycling and renewable energy companies down to Puerto Rico as well. So it's something to look into. Infrastructure, agro industry, creative industries like filmmaking, art, music, etc. There's the young entrepreneurs. So people, I believe, under the age of 36 or 34 can qualify for additional incentives. Aerial transportation, maritime transportation, cruise ships, opportunity zones. This is in the current stage of, I guess, development. A lot of Puerto Rico beforehand was considered an opportunity zone, but they're actually rezoning. So this is a little bit subject to change. Cash grants, credits for R&D, which we'll talk about on the next slide, and then ones for new small businesses, specifically in Vieques and Culebra, which are smaller little islands off the side of Puerto Rico. Let's talk a little bit about this R&D tax credit. So Puerto Rico's Act 60 provides a strong incentive for businesses to conduct research and development on the island. The main goal is to encourage innovation and high-value economic activity. Eligible businesses can claim a tax credit up to 50% of their R&D expenses, which includes employee salaries, supplies, and contracted services, as long as the work is performed actually in Puerto Rico. Any unused credits can be carried forward up to 15 years, and in many cases, this credit can be combined with other Act 60 incentives, like the Export Services Credit. Compliance is key, though. Businesses must maintain detailed documentation of their R&D activities and expenses and file annual reports with the DDEC. All qualifying R&D must occur primarily in Puerto Rico. Please note that your clients must actually apply for this tax credit and be approved before taking advantage of it. I've seen cases where they think it'll just come to them automatically and they don't apply for it, and then none of it actually gets included under the R&D tax credit. So it's very important that you have your clients apply to actually take advantage of it. This actually coincides quite well with some existing U.S. mainland tax credits. There are companies that actually focus specifically on bridging that gap to have companies maximize both the U.S. side of tax credits and then the Puerto Rican side of tax credits. So if this is something you're interested in exploring as well, I could also pass off some contact info to you too. As CPAs, our role is really to help clients maximize these credits while staying fully compliant. That means advising on proper documentation, accurate reporting, and coordinating with Puerto Rican tax advisors to certify that the R&D activities actually qualify under Act 60. We're seeing tons and tons of people move down for these R&D tax credits. A lot of people in the fintech space especially, but we're also seeing some brick and mortar types of businesses as well moving down to take advantage of the tax credit. Okay, so to briefly rehash the presentation, Act 60 offers significant benefits but requires strict compliance. Residency and sourcing rules are the most common pitfalls. The IRS is increasing enforcement. Documentation is absolutely critical. And CPAs are essential in helping clients maximize benefits while avoiding risk. Now, before I kind of end this presentation, I do want to touch a little bit about life in Puerto Rico. One of the really big questions I get is, what about the electricity grid? What about the quality of life? What options are available for people living down there? And my answer is, it really depends on how much you want to spend and where you want to live. There are very established expat communities down there. You have the Dorado Beach Resort, you have Moncayo Resort being built on the other side of the island, you have Palmas del Mar, you have a lot of gated living communities that offer very similar style of life that we're used to in the United States. But I honestly love areas like Old San Juan or Rincon or other areas. If you want to live in areas outside of those existing communities, they tend to be a bit cheaper. If you want to live in areas that are in those more expensive communities, I know that housing prices in Dorado Beach Resort start around the $3 million range for a condo. So it completely depends on that lifestyle. For your clients that have these types of questions, I would definitely recommend reaching out to a legit professional that has a presence in Puerto Rico so that they can actually walk them through what life looks like. The other question I get is about the electricity grid. I know that we often see that in the news that Puerto Rico's electric grid isn't great, and there is some truth to that. There are workarounds. A lot of the nicer buildings do actually have generators or backup generators. So oftentimes I see that as a great remedy to the solution. I spend actually a portion of my year down in Puerto Rico. And when I do that in the building that I like to stay in, we've actually never had an issue with electricity because we have two generators. So there are multiple ways around that. I think the final thing that I really want to touch on here, that's a usual FAQ that I get, but I haven't seen any pop up in the chat, is that this doesn't really work for W-2 employees. I often get that question, hey, I'm a software developer. I want to move down to Puerto Rico. I can work remotely. Ultimately, this isn't really the right incentive program for you. Now, I've seen cases companies actually prove their employees to work as a consultant instead. So if your client wants to establish themselves as a consultant, develop their own entity in Puerto Rico, and then contract their services out to their existing company, that's something that can totally work. Another workaround about this is if someone is a W-2 employee and they're in an industry that's quite hard to hire in Puerto Rico, there is the hard to recruit professional decree. And so if someone wants to hire people specifically down to Puerto Rico, but it's not an industry that's very popular there. So if you're a pilot or your client is a software developer or someone with a unique set of skills, they can actually get hired under an Act 60 decree for that hard to recruit professional. And that ends up being, I believe, after their first $100,000, they get a tax exemption after that. So there's a lot of different ways to use this if you're smart. And if you have any clients that are interested, but you're not sure if they're a great fit, again, I'd recommend talking to someone specialized in Act 60 because there's so many incentives under this. There may be a way to kind of squeeze it into your client. I did see a question pop up in the chat that says, what if someone wants to move there, but not just to save tax money, but to live there because they love it there? Will they still have to contribute $10,000 a year to a Puerto Rican charity? No. So if they're not applying under Act 60 and they're just going to pay regular Puerto Rican tax rates, they can just move there. The $10,000 a year to a Puerto Rican charity is for people applying for Act 60. So you're allowed to move to Puerto Rico, establish residency, and pay those normal Puerto Rican tax rates and not have to contribute that $10,000 a year and not have to, buy a primary home within 2 years. Those requirements for compliance that I'm talking about are strictly for people applying for Act 60. So just because they love it there doesn't mean they actually have to want to apply. If they want to receive these tax incentives, like I mentioned earlier, that is when they will have to do that contribution if they're applying for the individual investor decree. So this is really the end of it. If you want to learn more, please feel free to visit either of my websites. We have rachelfarriscpa.com, which covers my consulting side of things. And we also have TaxStack AI, which is my AI-powered tools for small firms. Feel free to connect with me on LinkedIn or send me an email as well. I'm going to give a few seconds just if anyone has any other last-minute questions, I'll be happy to answer them. And if not, then I think we are good to wrap up. I'll give it like 30 seconds. Okay, I just got one that came in. When you sell the home after 2 years, do you get the $250,000 gain exclusion? So this is a little bit complicated. There's actually more interesting ways to structure this that I see a lot of people doing. So a lot of my clients have actually bought the home with an LLC. So then when they sell the home, they own that LLC because it's a Puerto Rican LLC. Those gains are actually then taxed at that 0% because it's a interest, or it's like, interest dividend distribution from an actual Puerto Rican company. So again, it's not something we necessarily see the $250,000 gain exclusion. We see a lot more people structuring it the way that I kind of just mentioned. Again, there's actually a new law that's been introduced or being talked about being introduced that's going to prohibit people from buying with an LLC, but that hasn't actually been formally done just yet. So it's a very common way of people buying property in Puerto Rico under Act 60. I think the other thing I want to briefly mention too is I often get the question, well, what if I'm already a Puerto Rican, right? Usually, I believe there's a 15-year rule to qualify for Act 60 that you haven't been able to live on the island. But actually, they passed a law earlier this year that I believe they're kind of working out the inner workings of it that allows Puerto Ricans already to get a 4%. So 4% on capital gains, interest, dividends, etc. They'll actually still qualify for those rules. So they're trying to make it a bit more equitable than it has been in the past 5 years. And so hopefully we'll continue to see aspects of that getting improved upon. Are there any other questions? I'll give it another few seconds to see if anything else comes in. Okay, perfect. Well, thank you all so much for listening. If you have any other questions, please feel free to reach out on any of these platforms. And I look forward to hearing from you all.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.